So let's move on from there to trade policy, which has really been the big story over the course of the past month. The trade deals the U.S. has put together over the course of the last several weeks. We went through the spring in which the markets were very volatile due to uncertainty over trade policy. Now we've moved into the deal-making phase. Uncertainty metrics have declined, and we're starting to see new trade deals put in place. But as this chart shows, our second chart shows the new tariff numbers, the tariffs on imports coming into the U.S. are well above those that prevailed prior to 2025. You can see the deals on the books to date, at least the tentative deals on the books to date with the UK, Vietnam, Indonesia, the Philippines, Japan, and the EU most recently. Very roughly, we're seeing new tariff rates, agreement tariff rates that are 10 times the average rates we saw in 2024. So as an example, if we take a weighted average of the EU countries last year across the 12 months of 2024, U.S. tariffs on imports from the EU were roughly 1.4%. The new agreement for the EU is 15%, a little bit over 10x what we saw last year. The average tariff on Japanese imports last year was 1.5%. The new agreement rate is 15%, exactly 10x from where we were last year. So we're making agreements now, we're making deals, but these deals set tariffs at much higher levels than they were prior to 2025. Now, that does mean more revenue for the government. As of June, customs revenue, as booked by the U.S. Treasury, was up 321% from the same level in 2024. Huge increase on a year-over-year basis. But at the same time, that also means money flowing from the private sector to the public sector. That's restrictive fiscal policy. And that does suggest some weight on economic growth here in the second half of the year. There's also an inflation impact, of course, from new trade policy. So let's move on to the next chart and look at the CPI. We actually had a pretty well-behaved CPI for the month of June. The overall consumer price index was up last month by 0.3%. The core index was up by just 0.2%. So now we're at 2.7% year over year overall, 2.9% year over year for the core. Pretty good numbers based on where we were over the last few years, and in general, continuing this long-standing disinflation trend that we've been in for the past few years. But there were certain categories in this report that showed signs of tariff impacts. And of course, these are categories that are heavily dominated by imports: household furnishings, apparel, footwear, recreational commodities, toys. These are categories in which the majority of products sold in the U.S. are imported. And if you see the numbers here, the averages from January to May, for the most part, were very well subdued. The numbers in June last month shot up. We saw a big increase, nearly 1% increase in household furnishings. For example, big increases in apparel, at least relative to the prevailing trends. You can see for women's apparel, for footwear, we had averaged a decline in the first 5 months of the year, saw a decent sized increase. In June, recreational commodities had barely grown in the first 5 months of the year, much stronger in June. And then you see toys on the far right-hand side, modest increases earlier, big increase in the month of June. So we're beginning to see some tariff impacts here that we didn't see earlier this year. Probably weaker growth in the second half of the year. We're already beginning to see, at least in some areas, some higher inflation as well. So we want to put one of these numbers into perspective. So let's take a look at the next chart and look at toys and look at the numbers here in 2025 versus a long-standing trend. Toy prices, as this chart shows, have been in a long-standing deflation, not just disinflation, but outright deflation. Toy prices from the early 1990s until earlier this year, they bottomed in March of this year had fallen by nearly 79% cumulatively, going back over the last several decades. We had a 1.8% increase in June, however, and that 1.8% increase is almost as big as any increase on a yearly basis for toys that we've had in the past couple of decades. And that now sets us on a path for a 6.5% annual increase in 2025, and that would be the biggest increase for toys since 1981. So we've got a category here that's been in long-standing deflation, not just disinflation, but outright deflation. Now we're seeing some sizable inflation in this category, and it is tariff related.
To watch this month's complete analysis and receive daily updates directly to your inbox, become a member at cycleframework.com.